Diageo stock is now worth half what it was at the end of 2021 when its shares peaked at over £40. Since that high, the company has been on a downward tear through 2023 and 24, with shares falling 54.45% since then. So what's gone wrong, and should investors buy this dip? After a maelstrom of problems, including profit warnings, leadership uncertainty and economic headwinds, Diageo stock has fallen 27.49% in the year-to-date to £18.39, leaving it heading for its worst one-year share price performance ever. That is sobering stuff. Indeed, it's enough to leave investors questioning whether they can face another round with the parent company of iconic booze brands Smirnoff, Johnnie Walker and Baileys. For now, Diageo is in limbo. In July, Chief Executive Deborah Crew stepped back from her role at the top of the company after just 2 years. CFO Nick Jangiani replaced her on an interim basis and is the frontrunner to take on the role permanently. But that isn't likely to end the stasis. Jangiani already faces a shareholder revolt over £8.5 million of stock awards, and the company's commercial problems continue to mount in the meantime. As a retailer of premium spirits, Diageo is exposed to the economic cycle, and inflation in particular, and that renders its strategy vulnerable to the behaviour of cost-conscious shoppers. In recent years, its modus operandi has been to acquire high-quality premium alcohol brands, like whisky retailer Windsor Global, which it bought in 2023. But plenty of consumers are currently not in the mood to buy premium. Consumption trends are also changing. With low to no alcohol products now firmly a part of the hospitality landscape, Diageo has attempted to get in on the trend of health-conscious customers opting for hangover-free Saturday mornings. But uncertainty still surrounds the viability of that particular approach. Morningstar equity analyst Varushka Shetty has given Diageo stock a fair value estimate of £24.40, and that means it has a Morningstar stock rating of 4 stars and is currently trading at a discount of 24%. Giving it a Morningstar uncertainty rating of medium, Morningstar's Shetty thinks Diageo stock is still worth a shot. She says the drinks giant has a strong spirits portfolio with 30 of 150 available Scotch distilleries under its wheelhouse. There's also a tangible commercial benefit to it having relatively similar production costs across a ladder of brands it can charge incrementally higher prices for. And in the so-called super premium drink sphere, Diageo's empire is buoyed by high entry costs that will put off competitors. So in 2026, Shetty expects Diageo to outperform peers with a slight improvement to its operating margins. In addition, she anticipates cost savings of around $625 million as a result of Diageo's Accelerate turnaround plan. In the short term then, investors may not see immediate results, but Shetty is confident the next 5 years will be better than the last 5 have been for Diageo, and that investors will eventually be able to raise a glass to celebrate. For Morningstar, I'm Ollie Smith.